and they go back and look at them later. So that'd be great. I don't know how many people are going to join us. I mean, and I appreciate, you know, the big muckety mucks from LMCU doing this for us. So well, let's get what we can get out of it with the.
It's our pleasure. We want to be there for you. So we got some great facts to share. So we can't wait to talk to you and your team.
Well, good. And that was something that they mentioned at public policy this morning, was about the forbearance and different ways that some of the lenders are handling it, whether they're tacking it onto the end or calling this due right away. So that I'm sure that's something you're going to address, but it was interesting to hear it coming out of another committee today. Eric
has got some great information fresh off the press from Fannie and Freddie. We've been talking to them every day. Noel is head of operations, so he talks to Fannie and Freddie all the time too. So those are some of the topics we're going to talk about today.
Yeah. Okay, Jean's fixing her thing. She'll get, as soon as she gets her thing fixed, you want to just go ahead and then we can move forward from that?
Sure. We know your time's tight, but I just want to say, hey, Joanna, hey, Jean, hey, Carol. Good to see all of you. So thanks for joining. And Brian?
Hello, everyone. Thanks for having us. We're hoping to get you guys some good information about what's going on in the mortgage industry. I just want to do a quick intro for the panel speakers. The first gentleman that's going to be speaking is Eric Burgoon. He's the Chief Lending Officer with LMCU. He's going to be talking about the state of the mortgage industry and the forbearance issues and some other items with liquidity. Jane's then going to take it. She's the Regional Mortgage Production Manager in Florida. And she's going to give some updates and highlights on some of our products. And then Noah Watts, who's the VP of Mortgage Operations, is going to talk about LMCU's focus and what we're focusing and prioritizing in the operations department. And then Marty, our Chief Business Development Officer, is going to round it out and talk about some of the ways we're helping our members at LMCU. And then after we're all done speaking, if anybody has any questions, we'll open it up for questions. So I'm going to hand it off to Eric and let him take it from here.
Eric, you're on mute. Eric, you're on mute.
Hey, Eric, you're on mute.
Oh, there we go. Sorry.
Okay.
Are we good, Marty?
We're all set.
We can hear you.
Okay. Yeah, thanks, Brian. And a lot of chiefs on the list here, but we're really just here to support Jane and Brian in developing business and supporting you. So great lead in, JJ. I think that's really what I want to do is kind of jump right into the forbearance piece of it, because it affects so much of what has changed in our industry. So just a quick recap for everybody that is not familiar with it, but forbearance has been around as a servicing management tool for a long time. But when the CARES Act was passed on March 27th, it really changed, made that much more easy to qualify for a forbearance. So that's what really drove a lot of the change in the mortgage industry that we'll talk about here today. But some of the specifics of what forbearance, just maybe real briefly what it is and what it isn't. So basically, a forbearance is a temporary postponement of the payments, not forgiveness. It's important to remember that, but it's a temporary forgiveness of payments. And so the servicers continue to go ahead and make the principal and interest payments to the investors. Generally, we still pay taxes and insurance, and so everything remains current. But the borrower obviously gets to forbear and not make their payments for a period of time. So the CARES Act said a couple things that were very specific. You cannot start a new foreclosure proceeding. Any loan that's in forbearance would not be reported as delinquent on the credit report, and that a borrower could have up to 12 months of forbearance if they needed it. So as I said, forbearance has been out there, and is used, sporadically in different times in the credit cycle. But going into March, there were 0.2% of loans in the country that were in forbearance. So 0.2%. That has now risen to let's say roughly 10% in total in the country. So it's gone up from 0.2 to 10%. So 50-fold increase in forbearance. And so what it's done is it's made lenders, the credit markets, et cetera, worry about, does forbearance ultimately become a higher foreclosure rate? And we've all been through this. Obviously your market was pretty hard hit back in the crisis of 2007, 8, 9. So that's kind of the worry about it. That's why some things have changed in the mortgage business. But back to a little more specifically to JJ's comment and point. So what happens when a forbearance and how does it end? So what typically happens is a customer, a member of ours would call up, or they would call their servicer and say, hey, I need this. I've been affected by the COVID-19. I've got a hardship. And what we've generally done is said, okay, for 3 months, we'll do it without really any documentation. We're just going to defer your payments for 3 months. We'll talk to them at the end of 3 months and say, what's your situation now? And what we've seen is that, first of all, a number of things can happen. First of all, people have been granted forbearance, but have not even used it. They continue to make their payments normally. And that's a surprisingly high number of people. About 20% of the people have done that option. The second way that happens is that they get to the end of it and they say, no, it was sort of I did it for abundance of caution. It's really not a concern. I can make up the payments now. So they'll make those 3 payments, let's say, up immediately. That's called reinstatement. But then if that's not the case and their situation is evaluated at that point, the servicer has a lot of flexibility in determining what happens next. So we can modify their loan, we can recapitalize their loan, we can extend their loan, we can even change interest rate in some cases. That's not normally what's done, but let's say they missed 3 payments of $1,000 a month and they're ready to start making that up. We can have them, make an extra $100 a month payment for the next 30 months, or $50 for the next 60 months. We even have an option where payments can be deferred all the way to the end of the loan. So they don't have to be made up at that point, but they can be deferred to the end of the loan and made up when they sell the property, or ultimately pay it off, which could be, 30 years from now or close to that. So there's lots of different options. So maybe we got a good small group here. Let me just pause and see if there are any specific questions on that so far. Does that line up with what you heard this morning, JJ? Or I think you're on mute now, so.
Let me unmute. Yeah, that's what everybody was concerned about, was that if they couldn't catch up, if that was going to cause people to start going into short sales and all that other nastiness that was in 2007. I think somebody was overreacting, but.
Yep, we don't want to go back there, because that, and even though, again, 0.2% up to say 10% is a lot, 90% of the people aren't affected, but those 10% can affect values and can affect all loans and all real estate in general if that were to happen. So,
are you seeing a lot of people requesting this forbearance, or is it a very small portion?
We are seeing it's about 6% of our portfolio. So for us, that's about $550 million of mortgages that have taken the deference. About 50 million have already paid it back. So, and what we're seeing now is that the latest is that that it's really peaked about 5 or 6 weeks ago. So now we have just as many people coming out of forbearance or catching up as that might be going into it. So we were seeing, in the beginning of this, we were seeing, say, roughly 100 people a day, kind of coming into forbearance. We ended up peaking at about 2,700 loans in forbearance, but that is now sort of steadily ticked down. I think it's about 2,500 now, so it's coming down. I think we'll see that, across the board. So it's not accelerating. It's actually, to use the, the medical term right now, the curve has been flattened. So it's coming back down. So we've seen the worst of it, I think. And so, but that's good. So it really, the CARES Act, it worked. It did the right thing. It allowed people some relief and some ability to kind of see where their situation was. And now it's a very time-intensive thing, of course, because you got to talk to each individual person, structure it individually, and then eventually get to agreements as what is going to work for them. And that's kind of what really leads to the second part of that, is that how does this affect the existing mortgage business? So when somebody wants to, has been in forbearance, can they buy a new home is a question we get. What happens to that? So it's taken a while, but we did about 2 weeks ago got good clarification from Fannie Mae and Freddie Mac, and the answer is that borrowers are eligible to refinance or buy a new home if they've been current on their mortgage, in other words, if they were in forbearance but continued to make their payments, or if they reinstated their mortgage, in other words, made up the difference. So the difference can be made up. Let's take that example where somebody was deferred for 3 months. They did not make the payments, but they want to sell their house and buy another one from you. So what they can do is just when that loan is paid off, so they've got an outstanding balance, they do need to make up those extra 3 months payments. They can pay that $3,000, or they will just get less proceeds out of the sale of their current home. So that's a really nice thing, because that used to be 12 months, for Fannie Mae. They'd have to wait 12 months.
Does that affect their credit if it's pulled out of the sale or anything? Anything that
Nope.
forbearance would do to affect their credit? I think that's the biggest concern people have.
Yep, no, it does not. It does not affect their credit. And that is a
Okay,
loan that
that's
would be
great.
perfectly saleable to those agencies, and most lenders would be able to accept that.
Okay.
Eric, on the
Oh.
chat room, Gene had asked that same question. Is forbearance reported to the credit agencies?
Yeah, so good question, Gene. So you can see it, I guess I would say. So the rule is that you cannot report it as delinquent. So to JJ's question, you wouldn't count that against them as a bad loan or a delinquent loan that might affect the qualifying for the next loan. But it is known, because there's generally a comment that's put on the credit report that says, in forbearance due to COVID-19 or whatever. So that's where you'll see it. So lenders will be aware of that. The thing that we can all do together is really ask those questions early on. So when you're talking with your buyers, and if Brian's taking an application, et cetera, the sooner that we know about kind of what's going on, the easier we can deal with that through the process and make it go smoothly. You'll find out about it, and that's okay. We now know how to deal with it. The second piece of it, from a standpoint of what if they started one of these repayment plans, they started doing, let's say, paying an extra $50 a month. In that case, the borrower has to make 3 of those new payments before they're eligible to buy a new home. So if they, again, example where they missed $3,000 worth of payments, they restructured after the 4th month and said, we're going to make an extra $50 a month for the next 60 months. They have to make 3 of those payments before they're eligible to get a new mortgage. Kind of reestablish that new payment amount is kind of the goal there. So we tell people, if somebody has experienced a financial hardship due to COVID-19, they absolutely should do forbearance. But the thing is to not take it just to do it, because there are some implications. Again, it'll be known, it'll be on the credit report, won't be harmful that way, but you do have to make it up. So I think there's been a lot of kind of misinformation out there about, should you do this, should you not do it? And I think that, like with most any sort of common sense prevails. If you need it, you need it, and if you don't, you really shouldn't do it. It's not a free money sort of thing. It'll come back eventually. So, okay. The other sort. Yep.
Eric, could I ask you a quick question?
Certainly, yeah.
If they decided that they needed to take the forbearance and they were just at a spot where it was going to be a hardship to make the $50 a month, and they wanted to put that at the end of the note, would that affect them going into the next transaction?
Not necessarily. So let's say they said they can't make extra payment. So the agreement with the servicer is that it was fully deferred to the end of the loan. They would still need to then start making their original payment and make 3 of those original payments before they'd be eligible to buy a new house. And then again, that case, it would be with the payoff work the same way. There'd be those 3 payments at the end, that $3,000 that would get caught up when they pay off. So it's really good news, because for a while there, we didn't know, and it was hard to really even say what was going to happen. Could you even buy a new home was always, of course, the question. So that's pretty good news overall. But I mean, if somebody that has started their new, and you'll start to see it now. Most people are kind of right about that 3-month period or coming up on it. So you will start to see some people that have taken it that maybe are on these payment plans. To this point, it's all been really either reinstated or done with a payoff. But you'll start to see some people the rest of this year and into next year they will be making a different payment, as original. So just good that, and Brian can help you with that. If you find somebody, if you surface that somebody did take it, let's just surface that and we'll work through it in the process and make it go. Okay. The other thing that's important about forbearance is you can imagine that the fear of foreclosure with these is that it's really changed pretty dramatically the mortgage industry in just the last 2.5 months. So what has happened is that the value really of a mortgage has become much less because there's a bigger fear of loans going into foreclosure. And that's affected lenders in different ways. And I like to try to categorize lenders in really 3 major types. First of all, you've got your big banks. That's, your Chase, your Wells Fargo, Bank of America, Citibank, even some larger regional banks. And what they really are primarily focused on are their commercial accounts and their depository, customers, and sometimes investment services. They really don't like to be in the mortgage business. And I can say it, Marty and I and Jane have been with those big banks at times. They don't like the mortgage business because it's very volatile. Rates go up, rates go down, refinance. They don't like to hire and fire people. And so it's really a challenging, business for them. They're looking for very steady earnings growth that satisfy their investors because they're a publicly traded company. That's what they do to help move their stock price up. They don't like the mortgage business. So they've taken this opportunity really to cut back pretty dramatically. One example I like to use is Chase. Chase very quickly said, we're not going to do any mortgages for anybody that's not a current Chase customer. We're going to require 20% down on all of our mortgages. And they had several other, credit enhancements or overlays, as we call them, that added to their loans. Most of the big banks have really done the same kinds of things. So that's the first group of lenders. The second are what I would call your mortgage banks and your brokers. Smaller companies that generally originate loans, they put them on a warehouse line, and then they sell them to another investor. The investors that they typically sell these loans to, if it's not to Fannie Mae or Freddie Mac, would be these bigger banks that have correspondent, wholesale kinds of operations. Well, as you can imagine, those larger banks have really cut that back or eliminated products. So that's where you're seeing probably some lenders that can no longer offer a competitive jumbo product or can no longer, can offer a competitive FHA product. So because their investor has really pulled out. So they don't, these brokers and mortgage banks are really been hit, pretty hard with these changes because they don't have the outlets to place mortgages and they can't just hold them in their portfolio. The third category are what I call portfolio lenders. So these are your community banks, credit unions. Obviously, LMCU is in this category. And for those kind of lenders, not necessarily too much has to have changed. Now, some have changed anyway, but we look at Lake Michigan Credit Union. We went into this crisis with about a high balance for us, $1.2 billion in cash. That has actually gone up in these last couple months to $1.8 billion in cash. So we've got this cash on hand, and what we want to do is we want to put that to work by making loans, and mortgages is what we do. 75% of our portfolio on the banking side is really in mortgage residential mortgages. So this is what we do. So we don't have a warehouse line. We just fund these loans out of our own cash. So really, our product mix has not changed at all. We haven't raised our credit score requirements. We haven't raised our down payment requirements. We haven't eliminated any products. We're still doing construction loans at 10% down. And so there's really nothing that has changed, which puts us in a relatively speaking, a great competitive position. So there's stuff that Brian can do that many of these other lenders, big banks and mortgage banks and brokers alone, just can't do any longer. So pretty dramatic shift. So I think it's important to make sure anybody that you've got going through the process, reevaluate, make sure that they're still qualified, make sure that the lender that they're working with, if it's not Brian, is somebody that's that still has those products, because things have changed, and it's important to do that. You don't want to get to the 11th hour and find out that, well, wait a minute, I can't qualify. We've seen many instances where lenders our borrowers are coming to us because their lenders suddenly told them the 11th hour that they couldn't qualify. So, Jane, maybe you want to add a little bit to that, or we can take some questions here too, whatever, anything that you're seeing on the product side.
If anyone has a question, just unmute yourself because we've muted some people. So just unmute, or you can use the chat room to ask a question.
Well, thanks, Eric. I think most of you have known LMCU long enough now. It's been 5 years since we came to town, I'm really pleased to say. And JJ has certainly been a wonderful advocate for us and helping us grow. And I hope that, first of all, number one, all of you are staying safe from COVID, you and your families, after everything we've been through. And especially, as JJ has indicated, you really haven't lost too much ground with what you're doing and with your ability to sell and close real estate for folks. So that's great. And the good news is I'm glad that I live in Florida because we beat everybody else to it, because I think we're all going to see a mass exodus from some of these other states because everybody wants to live in paradise. So yay for us, right? It's good news. And surprisingly enough, we here in Florida, our team has actually had the best months ever since January. So despite COVID, we've actually closed more mortgages than we ever have before. So, that's a blessing, and we keep pinching ourselves and saying, hope this isn't going to end, similar to what I'm sure you're doing. But I just want to tell you how much we appreciate any and all of your referrals. And Brian is going to do a great job for you. And of course, I'm always available if you need help as well. But just as Eric has indicated, many of our competitors have put a lot of overlays on their deals. I just want to state that we have not added any overlays and we have not canceled any programs. Some places no longer offer mortgage insurance. You have to put 20% down. We are still doing 10% down on construction loans, 10% down on lot loans. Basically, we still have the first time home buyer program for conventional deals up to little as 3% down. We have a community edge program that we keep in our portfolio for our heroes, basically, which I'm sure you've all heard of. We have that program, which we can send you some information on. Our FHA guidelines, our minimum credit score has stayed at 620. So we're still doing FHA, we're still doing VA loans. And our rates are very competitive. So I'm pleased to say that we haven't increased our rates dramatically. And also we have, for those that you might have higher loan values, we have a jumbo buster program where up to $1 million, we can do a first and a second mortgage to avoid mortgage insurance. A lot of people really like that if they're relocating, because maybe they plan to pay that second mortgage down after they sell their house in wherever, Ohio or Michigan. We have a great doctor and dentist program, just really a plethora that we offer. And we are getting a lot of referrals right now from other lenders. But the bottom line is, we service our loans. So your people are going to be dealing with us. They're not going to be dealing with someone else. So they have that added touch where if they need help, we can help them here in conjunction with our servicing department, which I think is really important. Another factor that I think you might find very stimulating is we have a bridge loan program, which means if they own a home in Florida and they're trying to sell that home to move into another home that we're going to finance. So if we're going to finance the other home, we can do a bridge loan if they qualify in the home that they're trying to sell. And so it's interest only for a period of 12 months, and they can take the cash out of that home to use as the down payment on the new home. So we have lots of exciting things going on, and we really, really have not cut back at all. So I'm thrilled to say that, you're talking to the people who make the decisions. Eric, basically, along with our credit strategy committee, he's in charge, and Noel is in charge of operations. So, unlike a lot of other places, you're talking to the people here who are literally the decision makers. And Brian when it's Brian's turn, he's going to share a little bit with you about the growth. We're the #3 lender in the entire country of credit unions, even though we don't lend in the entire country. So we're the #3 mortgage lender. We're the #1 credit union in giving, in giving our revenue back to our members in the form of, lower interest rates on mortgages and higher interest rates on deposits. So that's just a sampling of all the things we offer. So with that in mind, I am going to turn it over, I believe, to Noel.
Yeah, as Noel kind of gets in here too, I'm going to give Jane another compliment. As you said, she had the best month ever. 52 million last month closed in Southwest Florida. And Jane is also number 3 in all of Collier and Lee County for purchase business. So little old Lake Michigan Credit Union under Jane's leadership here has become a player in your market. So we appreciate your part in helping us get there.
Can we put in a little plug? If you know any really good mortgage lenders throughout from Sarasota to here, if you know of any good lenders that are thinking about making a move, please let us know. Thanks. And Noel, you're on.
Hey, thanks, Jane. I just noticed in the chat, you went into a little bit about the bridge loan, but there was a question about the HEROES program as well. Do you want to cover that a little bit in a little bit more detail?
You bet. Our HEROES program, it's really a lot for first responders, you know, police and fire, and it's for teachers, and it's for people who work in hospitals. And it is a program that we hold in our portfolio. They can get, and it goes up to, I believe, Brian, is it 625,000 or 650,000? So it's not like your typical conventional loan. It goes much higher than that, which I think is a big selling point. It's over 600. And we hold this in portfolio. So basically we're doing anything, we're doing ARMs. And the reason for that is we're holding it in portfolio. And most first-time home buyers don't live in a house for 30 years. So just using a 10-year ARM as an example, they're not going to live there for 30 years. And because we're a credit union, we're offering substantially reduced mortgage insurance on these loans. So it's a great opportunity for people who are trying to get into a home and need a lower payment. And I don't know, Brian, do you have anything to add on we call it our Community Edge program. It gives us a little bit of an edge.
No, I think you covered it pretty well.
Okay. So Noel, back to
Thanks,
you.
Jane. Yeah, thank you, Jane. Thanks, Brian. And thanks everyone for joining. You know, we're excited to be here with you. Three things that I wanted to share is really our historic and our current focus on purchase business and how, you know, we really want to help you. And then we'll talk a little bit about, you know, how employment verification and income verification may have changed with COVID so that you can set the right expectations with your clients. And then we'll talk about appraisals and the overall market and valuations a little bit as well. So with that, just as Eric and Jane mentioned, you know, Lake Michigan Credit Union has always been focused on purchase business, and that means focused on our realtor referral partnerships. And today is no different. Interest rates are extremely attractive. We, along with many other lenders, are just getting record numbers of refinance applications that come in. But, you know, all of us here, Brian, Jane, Marty, Eric, and I, we remain focused on our realtor relationships, and we prioritize all the way through our process those purchase files. Our goal is really to help you all sell more homes, and we can use our financing tools and our process to help you achieve that goal as well. So some of the things that we do, you know, from the beginning of the loan process, when a loan comes in the door, all the way through processing, underwriting, and closing, we prioritize the purchase business so that those files for your clients, we actually work first as a priority in our process ahead of refinance files. So our goal is to minimize the turn time from application to closing in all purchase transactions. And that's just one way that we do it. Lake Michigan Credit Union's been historically 80%, 90% purchase business as opposed to as a lender that, you know, chases a lot of refinance business. We're certainly, like I said, getting record numbers of refinance applications today, and we're grateful for them. But from a long-term perspective, we really want to focus on helping you and helping your clients purchase homes as well. Eric mentioned kind of our position in the market, and you know, we have the strength that we're able to make business decisions around maintaining our guidelines. We haven't changed any of our guidelines. We haven't put overlays on them. But there are a couple of things related to COVID that we have had to do in terms of employment verification. So because so many businesses and employees have been impacted across the country, one thing that we do need to do today is verify employment 48 hours prior to closing. So we've always had to verify employment, but you might prepare your buyers ahead of time that, just right before closing, we need to re-verify that just so that they're prepared. And that's part of our normal process. The other thing that our position has, as a credit union and in the market, has allowed us to do is, like I said, sit back and evaluate the market and make business decisions as it relates to what's going on. We've heard, a lot of large lenders, super regionals, and even national lenders, make these guideline changes that, are kind of blanket policies, whether it be self-employed buyers or income and asset overlays that they put in. And we've been able to take the approach that we want to make the best business decision possible to allow everyone possible to qualify for a loan. So one area that we've done that in is self-employed buyers. Early on in the COVID environment, what we saw was, many lenders making blanket policies to say that they were going to look at self-employed income as the 2-year average of their tax returns, taking that 2-year average, and then discounting that or giving that basically a 25% haircut across the board. We found that probably unjustly penalizes some self-employed buyers. And so what we've been able to do is take the stance that, we know that some businesses have been negatively impacted, but we also know many other businesses have felt no impact at all and may have even increased their business during this time. So we've just come out with a questionnaire that we ask our self-employed buyers to complete. And it's one more step, but it's really a small step, and it helps us get the information that we need to evaluate and understand their business. So we ask for things like, any kind of business information they have on their business accounts, any contracts they've signed recently, and impact to their expenses and revenues. That gives us the best possible chance of being able to deliver an approval to that buyer, rather than, like I say, some other lenders really restricting their guidelines. We want to give everyone the best possible chance to qualify. And so, that's something that as you're out talking with your clients and prospects as well, to keep in mind that, we're going to do everything that we can, even for those self-employed buyers, to get them into the home that they're looking at. So I'll stop there for a second before I really go into appraisals and valuations. Any questions from an operations standpoint or anything that's come to mind? Okay. So the other thing that we've seen as an impact from COVID is the appraisal process. And we've seen the impact really come in 2 ways. Early on, we saw appraisers and sellers express that they might be uncomfortable allowing someone to come into the home. We had appraisers mention that they were uncomfortable going into homes. One advantage that we have at Lake Michigan Credit Union is that we manage our own appraiser panel. We do not use an AMC, so we have close relationships with all of our appraisers. And we sent out surveys to that group, and our appraiser panel is, I think in excess of 300 appraisers. And what we did was we asked for their comfort level in going out to inspect properties. Those appraisers that said that they were uncomfortable going into and doing an interior inspection, we direct our refinance applications, toward those appraisers. The appraisers that are comfortable doing interior property inspections, we focused our purchase business to those particular appraisers so that we can deliver the fastest, highest quality report to you for each property. Does that make sense? The other thing that we found was that early on, there were a lot of questions about the market impact of COVID and if values would be negatively impacted. We had several appraisers contact us to ask us if we were requiring them to put in some kind of an opinion statement in the appraisal about the negative impact of values to COVID. And our approach really has been the opposite. We felt all along that we just don't have the data necessary to determine any kind of a long-term market impact. We contacted Fannie Mae and Freddie Mac. They agreed with that standpoint, and the guidance that they gave us was that the appraiser should be giving us a value based on the market value and condition of the home at that time, without looking into the future to make any sort of speculatory statements. So we've been able, once again, to just make a business decision on how we approach the values as well. And frankly, the data that we look at is some of the same things that you see as well. You know, the supply versus demand. And in many markets, we've seen supply even shrink a little bit in COVID. Demand has remained pretty constant. And we don't see any data at this time pointing to any kind of a negative or decline in property values. We're even starting to read some things about how the limited supply is causing some markets to have increasing prices and increasing values. So a lot of strength is what we see, and a lot of opportunity is what we see in the market. So if there are no questions for me, again, happy to join in. Feel free to jump in or enter something into the conversation there. But if there's nothing for me, I'll turn it over to Marty Peltier, and he's got some great information about what we're doing in your local market as well. Marty?
Thank you, Noel. We appreciate that. Hello, everyone, and we appreciate being on this call. JJ, thank you very much for setting it up with Jane. We really appreciate it. What this meeting is all about, what the Zoom call is all about, is understanding the facts that are out in the marketplace so you can help your clients best to sell and list homes. So we want to help with the financing of that. And it's great to work with JJ. You know, all of you know how much energy she has, and she's so connected into the market with different organizations. And when she set up the Zoom call, it's all for you. So what we want to do is just be there for you. Some of the things that we've done, our branches are fully open now. So we're back doing business. We want to be there supporting you and your clients. One of the things that we want to just point out is, just like JJ shared today, there's misinformation out in the marketplace. And so to be part of this call, to stay connected with Brian and Jane, we haven't had those overlays, and we haven't changed our guidelines. So we're there to serve you. What we wanted to do is make sure that if you're working with a lender, make sure that they still have the products that they once had, because their world has changed dramatically in some cases, like Eric's pointed out. Economic data we wanted to share. For those of you out there, you're looking, it seems like traffic is up in the marketplace. The values have been really solid. Unemployment's up, but really we've come back faster than everyone thought. We bottomed in April, and we're about 1 month earlier than expected to have a rebound here. So nationwide, we're at 13.3% unemployment, and we were at 14.7. And in May, we had employment growth of 2.5 million. So the jobs are coming back. People are coming back. You can see it in all the different things. The business is opening. So good things on their way. What we wanted to do is just remember that this is a health issue, not a housing issue, like some of us have experienced back in 2008 that have been in the market a long time. That was a whole other situation. And so now the markets will hopefully come back sooner than later, and we can get together and get back to normal as soon as possible. Another thing, in times like this, you really want to seek out good partners that you can trust and understand what they're doing. And so the leadership team that's on this call, Eric and Noel and Jane and Brian, they've been around a long time. You know, they've been in the marketplace. They've seen a lot of different things. They've gone through tough times, and you really want to partner with people that are going to stay the course. And I really feel like Lake Michigan Credit Union has done that. Leadership has stayed the course and continued to lend when some other banks and regional lenders have either reduced or completely gotten out of the marketplace. So those are some of the things that we wanted to mention today. When all this started back in March, our leadership team at LMCU got together and started to brainstorm of how could we properly help our members. And we came up with a few different things that could help and assist you as an individual, as a member of LMCU. One of those things is a program called Skip a Payment, where if you have a credit card, a boat loan, an auto loan with us, you can contact us. At the end of this program, Brian and Jane will send you an email that'll have an information sheet on it that'll give you all the phone numbers and websites and links that you need to get information that we've talked about today on the call. Everything from forbearance to these programs that I'm going to mention to you right now. So this Skip a Payment, we've waived all the fees. you contact us, we work with you, and we can help you if you have reduced cash flow at this time. The other thing that we did was we increased our credit card limits. We've increased lines of credit and worked with our members to do that. And then we have a program called 3% Max Checking. It's been rated one of the best checking accounts in the nation. And we've continued to pay that 3% during this time. And we've waived all the requirements for that program. If you have that program, you know how great it is. If you don't, you might want to reach out to us and inquire. Just ask any LMCU branch, Jane, Brian, and we can give you more information about that program. Awesome program. And then we also have a program called the Special Relief Loan. Starts at 1.99% APR. We'll loan up to $12,000. It's a 5-year term, and it's just to help if somebody has reduced income. If you needed some cash flow, we're there to support you with that loan. So we wanted to come up with that. The other thing that I wanted to point out is in the community, we've really stayed connected. Jane does a huge amount of work with charities and programs in the program. Let me just do this. So what we did was we worked with different hospitals. We have a program called Band Aid, and we give about $70,000 a year to hospitals that are in Michigan and Florida. We also are always the main sponsor for the Parade of Homes. So we had 30,000 shoe coverings, and we donated those 5,000 to Lee Health and 5,000 to NCH. We wanted to give back any way we could. And another program that Eric got together with his leadership team and brainstormed and thought of in the months of May and June, what we did was we took $50 for every purchase and construction loan application, and we're going to donate that to a local food bank. So the Harry Chapin Food Bank is a food bank you probably know about in your marketplace. It seems like food banks right now and a lot of charities are, having a hard time meeting the need of the people that are in the community, and we want to give back, and we're going to donate that. That'll equate to about between $30,000 and $50,000 each month. So we want to give back to that food bank. It helps a lot of people in your community. So we wanted to do that and really help those that are in need, because this COVID has affected people in all different ways. Some people have come back really fast, and others it's going to be a while. And so we want to be there for the community. So let us know if there's different ways that we can help you. Stay communicating with our people, Brian and Jane. We're here to serve you. Every day we have calls to try to find solutions to challenges that are in the marketplace. If you have a client that has a certain need, let us know. Every deal looks different, as you know. So we're there to talk, brainstorm. Noel has an outstanding team that's very, very good and experienced, and they'll find ways to figure things out. I talk to Jane almost every day, and she's always communicating with the team to find solutions that when the loan officers bring opportunities to us, that we try to figure things out. Eric's always on the call trying to come up with solutions with Noel. So we're there for you, and let's work together and partner. We appreciate all the things that you do. And I'm going to turn it over back to Brian to wrap up the call.
All right. Well, thank you, Marty. I think basically what you heard is LMCU is open for business, and we're focused on the purchase business. So we want to support you and support your clients. And while other ones are pulling back, we're moving ahead full steam. If you didn't know, there's a new branch in Cape Coral that's open. So we have a larger presence in the Southwest Florida area. We also have another office off of Cypress Lake that's close to your Fort Myers office. So anything that we can do to help you or your clients, we're here. So are there any questions that you guys have outstanding? Was there anything in the chat box that we need to address?
Actually, Noel had responded to JJ about unemployment. Noel, do you want to share with the team what you said on the chat box?
Yeah, sure, Marty. And the question that JJ posted was around, an unemployment blip and how would that affect qualification. And really, if the unemployment was a short-term result of COVID and they've returned back to their original employer, we can just contact that employer to verify their current employment and income to make sure that they're that they're back full time and qualify for them for their loan. We can also look at their current pay stubs and collect, pay stubs just like we have, throughout our process, even before COVID. So if it's just been a short-term impact, there really isn't any risk to qualification as long as they're back, to work with that same employer, and we can make that a pretty streamlined process.
That's really nice to know, because I think that's a fear some of our customers have. They're all kind of holding back a little bit. That's our only real holdback, but everybody else is excited. Like Jane said, everybody wants to get out of Florida, and no offense meant, but Michigan, you guys are getting hotter than Florida. I was watching that this morning. We're only like 2 degrees hotter, and Michigan is like almost 4 degrees hotter than they normally are in summer. So we're going to be the coolest place in the summer to be. So that should be positive. And we love to partner with people who are positive and have big, generous spirits and get involved with the community and come up with products that work for the times. And you guys seem to be flowing and nimble with it. So that is like fantastic. So thank you again. We look forward to doing lots and lots of deals with you.
Thank you. And JJ, thanks for being such a wonderful friend to LMCU. I know you publicize our name a lot, and I like to refer to LMCU, Lake Michigan Credit Union, personally as Love My Credit Union. So anything we can do, and I know we have a couple of people in the audience right now who do business with us on the retail side, and I just want to thank you for doing that. And don't forget to stop by our branch in Cape Coral and say hello to our branch manager, Deborah Arnold, and to also see Brian. And we have a closer who closes our loans right there, but we keep her a secret because we don't want anybody going in and chatting with her. Otherwise she gets
Where is your office in Cape Coral? We're just moving this week in our office in Cape Coral. So you're where now?
Yes, great. Well, we're at Four Freedoms Park, the old Sunshine building that we renovated.
All right.
We're right there.
Okay.
So, and you have to give us the address for your new office. So
All right, write it all down. 836 Lafayette Street, Suite 2. Go to Starbucks on Cape Coral Parkway and turn, and you'll run right into our building.
Well, that's real close to us. So great. Great.
Right by Paradise Pizza. So at 3 o'clock in the Elks Lodge. So, in the afternoon, we can make sure everybody gets their libations.
Thanks again for letting us do this today. We appreciate it. And we recorded the call. So if you want to pass it along to your other folks, that'd be great.
And Jane, aren't they all welcome at your tiki hut on Cape Coral? Any afternoon?
You can all come to my tiki hut.
Oh, there you go. That sounds like fun. All right. Y'all have a fantastic Thursday. Bye-bye.
Thank you, JJ. Thanks, everybody.
Thank you.